So till now we have seen all the aspects of the financial instrument chapter. So now we will discuss about the derecognition, the last aspect, because we started with the recognition here. Initially we started with the recognition. In recognition we have seen that how the new things are happening, like they are mixing, okay, so they are doing certain things, that we have understood how to separate it, okay, like swan separates the milk from the water, no? So like that we have understood how to look something very objectively and take out, okay. And then we will look into the derecognition. Derecognition, we will see here we brought something into balance sheet. Now we will learn how to take out from the balance sheet. So we'll start with certain theory. Yes, so derecognition, we will discuss about the two things. Like recognition also we discussed about the recognition of the asset and liability. So derecognition also goes the same way. We derecognize the financial asset and the financial liability. But why we have to discuss about this? See, before I proceed, I would like to give you example of one company called Enron. You must be heard about it. You must have heard. One big accounting fraud happened. What exactly happened? I'll just tell you one gist, okay? Maybe the modus operandi might have operated different way. See, now this Enron, they wanted to become big. How? By showing good profits. Who knows the reality? Somebody might borrow the money and go in a Mercedes Benz. People don't know. No, they say, oh, that person is a rich. But inside story, that person only knows. Now, this is the balance sheet. They booked the revenue by discounting the future cash flows, long-term contracts, not a booked. So they pass the accounting entry, debtors account debit to revenue. Revenue will go to the retained earnings. Debtors will be coming in the balance sheet. This one accounting entry came. Now, how long you can keep this debtor in your balance sheet? So they went for securitization. What is securitization? Have you heard about securitization? Yes, again in AFM you are going to cover one chapter. You create one entity called SPV, special purpose entity, sell this debtor to them. They will pay you cash. Arey Baba, it is you only created that. How you will pay to yourself? No. This special purpose entity is going to cut these debtors into pieces. And pieces they are going to distribute to all the investors. Now, why on earth these investors are going to invest in one unknown SPV? They will collect the money. Now, what they happen? No, this Enron gave the guarantee to them that in case those debtors don't pay, and these people don't know the debtors also. They don't know the SPV, they don't know the debtors. Why on earth they will invest? Enron gave the guarantee. Look, it is my debtors. Tomorrow if they don't pay, I will pay. So like this, they gave the money and these people passed one accounting entry, bank account debit to debtors. Now if you look at the balance sheet looks very clean. People doesn't know a creative accounting happened there. If things are fine, if there are really proper debtors, then things are fine, because securitization is a tool to collect money. It's a very nice instrument, but somebody will misuse that to clean up their balance sheet. They got the money now. Followed, no? And these debtors are not going to pay. So at that time, our accounting was not strong enough to catch. But today, it will come with certain test. You say, I want to remove some debtor from my balance sheet. Remove, no. But wait, I will ask you certain set of questions. If those questions pass, you remove it. Fail, keep it. Again, learning. Followed, no? Previously, this learning was not there. So previously, people used to fool auditors, accountant, everybody, investors, everybody in the world. But today, they will try to fool, definitely. They will come with the innovative things, but we will not permit them. They will sell the asset, but enter into one more contract, swap contract. It's called a return swap. You keep the asset, but the returns are for me. Baba, what type of arrangement is this? Then what you sold? If you sold, the risk and return should go. You retain the risk and reward, but for the documentation sake, risk and returns have transferred. No, these type of things are not going to happen. Followed, no? This is one case. And second case, this is for the financial asset. You want to remove the financial liability. How? By paying. But sometimes you don't pay. You modify it. You ask the more time. You remember yesterday one problem we solved with the financial asset. Employee could not pay, 2,50,000 only he can pay. It is like a modification. So when modification happen, how we should account it? That's what we are going to learn here. So what are the rules of the financial asset? De-recognition of the financial asset. You see, if it is a genuine, fair transaction, then again we don't need all this test. Your accounting entry is very simple. Debit whatever comes in, credit that financial asset, finish. But if you get into certain complex transactions, then we will not permit it to happen. It means the removal of the assets or liability from the books. Say on the sale, payment, renegotiation, default, whatever it is. Now, what are the principles of derecognition? So, there are so many examples given in your study material. They have discussed it in detail. But till now, in the last 11 attempts, no questions have been asked on this. Followed, no? We will solve one question. There is only one question, illustration 12, 12A, 12B, 12C. I have clubbed it and we will pass one, we will understand it. But these examples, once you understand, you can go and study it yourself. So, there can be three scenarios. One, you derecognize completely. That means when you sell, bank account debit to debtors, finish, factoring, no more. It is not going to come back to you, no recourse. Derecognize. Or recognize completely. That means you never transferred. You said you transferred, but you still retained it in some other form. Or a new concept called a partial derecognition. That means you neither transferred nor retained. Like Enron case. Now, what is my starting point? First, I need to check, is my right to the cash flow has expired? If your answer is yes, that means that financial asset is dead. Derecognize entire. There is nothing more now. Because a dead asset you cannot transfer to anyone. No. Who is going to buy in the market? Somebody is going to buy the asset only if he has got a right to receive the cash. Cash flow itself finished. Remove it. No, cash flow not finished. It is still there. Did you transfer the cash flow to somebody? Right? Did you transfer that right to somebody else? No. That means retained, no? You didn't sold it to anyone. Still the asset is giving you the cash flow, say debenture, share or whatever. Keep it in the balance sheet. No, I sold it. Oh, that means there is one sale agreement. You produce one sale agreement. Then after going through that contract, I will say, did you transfer the risk and reward? Sale agreement is there, but risk and rewards are with you only. If answer is yes, yes, you have transferred the risk and reward completely. Like factoring you have done. Your debtors you have sold completely and told that factor, look, don't come back to me again. Still with me. I'll go back. That is further. That means there's no, that's what I told you, use the word called no recurse. Recurse. No recurse means don't come back to me again. Finish. You take it, your headache. Then derecognize completely. Pass the entry bank account debit to debtors. No. Now comes the challenge. See, asset is still alive. You sold it. But risk and rewards you didn't transfer. Means what is that scenario? First question, did you retain the risk and reward? Like for example, you sold the asset and you have got one more contract and you told that, look, whatever benefits come from the asset, you have to give it to me. If anything happens to that asset, I will bear the risk. That means you transferred your asset to an agent, no? Or you might have pledged your asset with the one bank and got the money. So when you pledge your asset with the bank, okay, so you have pledged, you have got a gold. Gold you have pledged with the bank. Now, the risk and reward is with whom? If tomorrow gold prices goes down, whose risk it is? My risk. Gold prices go up. Who gets the benefit? I get the benefit. So what I must have done, I must have pledged it as a loan, but I don't want to show it as a loan because my ratios will get affected. I have told that party, okay, we will show it like a sale. And when I get, no, I will buy this back from you. Sale with the buyback. In that case, don't derecognize, recognize it fully. Then you'll ask me one question, sir, if I recognize fully, I have already transferred it. That means I must have got a cash. What to do with that cash? What accounting entry I should pass? You are telling me two financial asset don't do. But I got bank account debit. No, that party gave me cash. No, what should I do? It's a credit financial liability because it is a loan to you in substance. It's a loan to you. No, you kept it like one pledge there. If it was not the pledge, if it was really sale, risk and reward also should have given to that person. Have you understood this? Now comes, no sir, I didn't retain the risk and rewards. Did you transfer? I didn't transfer also. Or I transferred, but I have retained some portion. So now, did you retain the control over the asset? No. Then de-recognize entirety and recognize one associated liability. That means, did you retain the risk and reward? No. Like sale with the guarantee. Like I have sold, but I have guaranteed certain things. Now in this case, return is going to come to them only. Risk is with me. But is it full risk? No. Partial. Like I sold the debtor for 90 crores and said up to 5 crores I will guarantee. So my risk is up to 5 crores only. Followed, no? So who is retained the control over the asset? Did you retain? No. Then de-recognize in totality because your assets, return, risk, everything was gone. But since you are keeping some portion of risk with you, some portion, recognize that associated liability like bank guarantee. Should we pass an entry? Yes, that 30,000 rupees, the differential, whatever it is there, no, fair value of the guarantee. No, but you are managing it like securitization. Asset is within your control only now. Debtor is within your control. Also, you have given bank guarantee for full amount there, or whatever, partial amount, whatever. Then continuing involvement approach, it is called a partial derecognition and recognize associated liability. Liability is bank guarantee. And you have to keep some portion in the asset. So this accounting is something new which we need to learn. This is very easy. Don't pass any entry on. This is also very easy. Pass an entry bank account debit to financial assets. This is also easy. Bank account debit to financial liability. This is also easy. But the only thing is, this is something new which we are going to learn. It's called a partial derecognition. Okay, we'll solve the problem. Okay, let us understand here cases. What is this transfer of risk and reward? Some examples we'll see. Transfer of risk and reward test we need to perform. Say if they give some example, entity has transferred all the risk and rewards of the ownership, like unconditional sale. I told no recourse sale. Sale but option to repurchase. That means I will sell you, but I have got one option to buy back. But at its fair value at the time of repurchase, then it is same, no? That means late I have told, look, I will sell you today, but I will buy it back from you at the end of the year at whatever market price it is. Then it is one and the same. It is a fair. That means today I can derecognize. Sale plus put or call option, that is deeply out of money. Out of money means I have told, okay, I will buy this, I will sell it to you. I will give you one put option. If you don't want that asset, you sell it back to me. People will tell, no, you take this vehicle. If you are not happy, you give it back to me. But you are giving back to the put exercise price is so deeply out of money, no, you will not exercise only. Like I have sold you for 100 rupees and say, if you are not happy, you can sell it back to me at 10 rupees. And I know that you will never come back to me because its scrap value is 25 rupees. This is called a deeply out of money. If such type of contract comes, we can say that we have transferred fully risk and reward, because the buyer is not going to come and give it back to me, or neither I am going to take it back from you. Are you clear? There are some examples. They may, very rare case, they may ask you, but in new syllabus I don't know what is the pattern. Now examples of when the entity has retained the risk, which is this point number 5. Retain the control over the asset. Entity retains the control. Like transferee, that means you, has got practical ability to sell the financial asset, and entity has got no control. Like when do we say we are controlling? So transferee has got entire rights. like sale plus option to repurchase, but the asset is traded in the active market where the transferee can readily obtain the transfer asset. Let me, I have sold to you and I have got an option to buy it back from you. But that asset is such that you can sell it to any time, you can go from the market, buy it back to me and give it to me. If that is the case, no, then we can treat that this sale is a normal sale. Why? Because at the end of the year, suddenly I say, no, give my asset back, give me a debenture back. You can go to the market, buy debenture and give it back to me. It's not that you know, you may not get that once you sell. It's not a shares of a private company because it's not traded. It's actively traded. So if I sell my shares to you, there can be one condition that I will buy it back from you at the end of the year. But if that share is actively traded, you can give it back to me anytime, then I will treat that control has been passed on to the buyer. Followed, no? Have you understood this test? When do you see that control is transferred to the buyer or it is retained by the entity? Now, one more example. Okay, examples of entity has retained the control. Okay, entity retains the control. I think I missed it. This part I missed to tell you. Examples of the entity has retained the control, risk and rewards of the ownership. Like, see, if I have made an unconditional sale, risk is gone completely. Sale plus option to repurchase at fair value, I have transferred you the risk. Sale plus put option, deeply out of money, transferred the risk. But if I buy sale plus repurchase at a fixed price, and I say, no sir, this type of odd sale, I never seen that. Like for example, today only I will go buy a washing machine, and that washing machine he gives me an offer. At the end of the year you come to me, today I have sold you 10,000 rupees, no? At 8,000 rupees I will buy back from you. That means there is a risk with him only. I may come and sell at 8,000 rupees, spend additional 2,000 rupees, buy one new washing machine at the end of the year. Security lending arrangement. In AFM we have got this, like I will give my security to you, but you have to give that security back to me after some time. Sale plus total return swap. I have sold to you, but whatever dividend, capital appreciation, you have to give it back to me. What type of arrangement it is? Sale plus deep in the money call or put option. Like I have sold to you, at the end of, like I have sold one washing machine to you, and I am telling you at the end of the year you can sell it back to me at 20,000 rupees. Tell me, within the moment I open my doors to the customer, my washing machine is sold, no? Everybody will take that washing machine. Why? Because it is deeply in the money option for the holder. Anybody will take that, no? Because they can sell it back to me at a higher price. In the money means the option holder they have got. That means your exercise price is more than the market price. Out of money, at the money, in the money. And sale of receivable plus entity guarantees, securitization. No, these are all cases you have not transferred the risk. And when you have retained the control, sale plus option to repurchase, asset is actively traded. Sale plus option to repurchase by the seller, asset is not traded in the active market like private company shares. Okay, these are all the examples that the transferee doesn't have a control. That means even though I have sold to you, you literally don't have a control because I enjoy one option. I can buy the shares back to me. Like for example, there is one sword, for example. I will sell that sword to you, that belongs to one king. And I will retain one option that at the end of the year, I can buy this sword back from you. Now, can you sell this sword to anybody else? Gone. Because that sword is not actively traded. You take a risk there. Tomorrow, if you sell, you may not get it back. But shares is actively traded. You sell shares, and if I want it, you can buy it again to give it to me. Understood, no? So, this is the case. These are all the tests. Again, right now at the final level, we need not go that much deep because questions not been asked. But just know that there is such a deep test which is supposed to happen in real life. And if it passes, okay, put option or a guarantee, but there is a constraint for the transferee from the selling asset without attaching similar. That means I have put certain conditions. And I have told, look, if you want to sell this, such conditions you have to put them also. Like I have sold one asset, one building to you. And I have put certain conditions. This building should not be used for this, this not be used to use this, I given condition. And I have told you, look, if you want, you can sell it to third party, but similar condition should be there. And I know that with that condition, nobody is going to buy. That means literally what I am doing, I am pledging my building to you, taking a loan, and I have never transferred the control to you. See, people have got a very creative ways to show it to that it is not pledged, it is actually sold. Because they put so much restrictive conditions. People, for outsiders, they paid stamp duty also. Registration also happened in somebody's name. But literally, in substance, it is actually not sold. Because the buyer doesn't enjoy it. He just keeps it. Why? Waiting for the end of the year, when the seller gives his cash back to him and buys it back from him. Tell me what type of arrangement it is? Loan arrangement, no. Then why you told all this security, registration, sale, tax? You paid tax also on that. Baba, you wanted to do creative accounting like Enron did, and we are not going to permit it. As simple as that. Followed, no? So, how the accounting is going to happen? If the accounting, if you are going to derecognize totally, like in these cases, if you want to derecognize totally, then your accounting entry is very simple. Derecognize asset, to asset, recognize the gain or loss in the P&L account, because book value goes out, bank comes in. If there is a debt FVOCI asset, it is equal to P&L account. You must have created some reserve. And equity FVOCI reserve transfer to. That means if that financial asset happens to be debt, classified at FVOCI, recycle. If it is equity, then take it to retained earnings. What if it is, you have to recognize continuity? Don't pass an entry for that asset, let that asset remain in the balance sheet only. But when you got the money, for the cash received, you pass the financial liability entry, present value of the future cash flows. Normal financial liability. What about the partial derecognition? It's called a continuing involvement approach. Recognize your involvement there. How much exposure you have retained? Again, 5 crore guarantee, no? Just retain 5 crore, that's it. And recognize liability to the extent of 5 crores. So that outsiders know how much extent you are still involved in an asset which is transferred. Now, there can be so many different type of scenarios, students. But in your CA final syllabus, they have given you one example of partial derecognition for sale of debtors. Just like we discussed that previous this thing, no, embedded derivative. There can be so many types, but in your syllabus, 2 types of embedded derivative: prepayment option and export and import case. They have discussed. So what is this? The continuing involvement approach will be the lower of book value of the asset or guarantee amount. Like you might have given guarantee more than the book value, meaningless. We will recognize up to the book value because book value of the asset. Or book value is very high, 90 crores, but you are given guarantee only for 5 crores. To the extent of 5 crores only we will recognize, because your liabilities are only up to that. Associated liability will be guarantee amount, whatever guarantee you give, plus fair value of the guarantee. What is the fair value of the guarantee? We discussed. That means if I want to get rid of this guarantee, I would have given this to some third party. Or with the guarantee, how much cash I am going to get. Without guarantee, how much cash I am going to get. The difference is my fair value. Are you clear? Yes. So we will solve one problem on this particular case. Then we will discuss about the financial liability part. Okay, derecognition of the financial liability, financial asset and debt equity swap. So 3 things we are going to discuss here. Now derecognition, we already discussed. I'll just skip it. Followed, no? We just discussed this in the chart only. So financial asset. So step number 1, you have to consolidate all the subsidiary, because what you might have done very intelligently, from one subsidiary you might have transferred to another subsidiary, but it's still there within your group, no? So first you need to consolidate all the subsidiary, all the SPVs. Then check, did you partly you have done or fully you have done? Rights to cash flow has expired. Did you transfer it? Contractual obligations still continues to pay. Transfer substantially all the risk and rewards and retain the control. I showed you in the form of one chart. Okay, so this way the chart goes. That means first you consolidate, you check all the part of the assets or full the asset. If expired, close. Not expired, did you transfer? Yes. Or did you transfer? You didn't transfer. Okay, but you have no obligation to pay also. That means you have retained the assets. Risk and reward, all the cash flow what is coming, are you supposed to pay someone? No, you retain it. No, but you are supposed to pay to someone. Again, you need to check who is maintaining the risk and reward of this asset. Am I acting as an agent? Okay, then retain the risk, retain the control. No, de-recognize. Yes, partial. Rather than this chart, you please refer my chart there. So accounting we discussed. Transfer, de-recognition. If the transfer results in de-recognition, recycle, retained earnings, de-recognition. If they do not qualify, then continue recognition and recognize the financial liability. And continuing involvement approach will be continuing involvement asset, which is the higher of guarantee amount of the book value. Associated liability will be guarantee amount plus fair value of the guarantee. Okay, so this is that final thing. When you solve this, you have to recognize this. Okay, this example we discussed previously. Again, just to remind you that I want to sell debtors worth 90 crores. Gave guarantee also. So this is my L1 input. If what is my fair value of the guarantee? If I can transfer my obligation, my headache to someone, and if that party charges me something, that is my fair value of the guarantee. Followed, no? So what is my total associated liability? It is 5 crore plus fair value of the guarantee. Now, question number 55. Entity C agrees with the factoring company D to enter into a debt factoring arrangement. Under the terms of the arrangement, the factoring company B, C and D are the two companies, okay? Under the terms of arrangement, the factoring company B agrees to pay. Okay, now that D has been changed to B here. It's the B only. Pay 91.5 crores less servicing charges of 1.5. That means net 90 crores they will pay to C in exchange of 100% of the cash flow from the receivables. Now, how much is the 100% cash flow? The receivables got a face value of 100 crores and the book value of 95 crores. So what happened? The first accounting entry must be debtors to sale. Who passed this? C. How much? 100. First, when you sell, what will you pass? It's called a face value of the receivables 100. First time you passed. But the Ind AS 109 says the day when you pass the entry, you have to provide a 12-month ECL. And if you find some problem, lifetime ECL. What is the accounting entry you would have passed for lifetime ECL or 12 months ECL, expected credit loss? Will you recover full 100? No. You think that 5 I may not recover. So you pass one entry, expense account debit or P&L account debit to loss allowance account. And loss allowance you deduct it from the face value of the debtors. So how do you present in the balance sheet? Debtors 100 like minus loss allowance, which is nothing but RBD 5. So book value is 95. This 95 they are buying at 90. In fact 91.5, but there is a processing fee also. So they pay you 90. So literally I have made a loss of, already I have made a loss of 10. Out of 10 I have already booked 5 in the name of loss allowance. 5 now I will book on the date of sale. Now, if this is the case, simple. This is the first PUC or second PUC I should be discussing this. Followed, no? If it was a proper plain transaction. But what happens? The customers will be instructed to pay the amount owed into the bank account of the factoring company. They say, oh, look, going forward, don't pay me. Pay to that factoring company. Because you have been purchased by them. And they will follow you up. Entity C also writes a guarantee to the factoring company under which they will reimburse any credit loss. Why this was required? If this was not required, I am done. No, I have sold to you. I have told my customer, go and pay them, settle. Don't come back to me. I am done. I'll pass an entry, bank account debit 90, loss account debit 5, 2 debtors 95. De-recognition completely. But since I gave one guarantee, that means I am still associated with this. My headache is still not gone. and above credit losses of 5, that over and above expected, that means 5 I am already expecting. 5 there can be more, okay, and losses up to 15 crores are considerably reasonable possible. That's not my headache. There can be still 15 more, up to 5 I will reimburse. Rest is that factoring company's headache, and but they are the professionals. They may recover full 100 out of 100 also. They have got gundas with them. I don't have any gunda in my company. My business is to focus on my business. Now the guarantee is estimated to have a fair value of 0.5 crores. What is this 50 lakhs? That means if I would not have given this guarantee, he will not pay me 90, he will pay 89.5, or he will pay 90. If I want to get rid of this 5 crore guarantee, New India Assurance is going to charge me 50 lakhs to take over this. Now what I am supposed to do? Calculate the amount of continuing involvement asset. Simple. Higher of the book value or the guarantee amount. Calculate the amount with which associated liability, guarantee amount plus fair value of the guarantee. Pass the journal. Okay, so we will do this. One, continuing involvement asset. Solution. Continuing involvement asset. CIA is recognized at rupees 5 crore. Sorry, not higher of, lower of, which is, yeah, makes sense. No, because my asset is up to book value or my involvement. How much is my involvement? 5. Going forward, I don't. So, book value of the asset which is rupees 95 crore or guarantee which is rupees 5 crore. So, which is lower of, okay, so you have to write which is lower of. Second, what is my associated liability? Associated liability is equal to guarantee amount 5 plus fair value of the guarantee is equal to 5.56. Is guarantee plus fair value of the guarantee. So, very low probability this question may come because it is a very simple, just because, but we can't say no, ICI. They may ask. It's a simple thing. Anybody can do this. So, this is my fair value. What is my journal entry? This is clear, no? What is my journal entry? Right, third, journal entry. Can you tell me the journal entry, students? Now it is your turn. If you want help from me, I can help you telling bank account debit 90. Two, receivables 95 because 95 goes out. Did I made a loss? Yes, I will say loss on derecognition in P&L. How much? It is 5.5. 5 here plus 0.51 liability also, fair value of the liability. Guarantee is also my cost, no? Continuing involvement asset, debit. One new asset comes in the balance sheet. By looking at it, no, somebody will ask me the question, what is that asset? Then tell the story. Previously, you are not telling the story that you have got an asset sold but still retaining it. Now you have to disclose this continuing involvement asset, something new item. How much? 5. 2. Associated liability 5.5. Explain this. Literally, what you are doing now, if you see the net amount, see here, if you look into these 3 journal entry, you are literally, what is that called? Booking the expense of a guarantee. Previously, guarantee was not shown in the books of accounts. But today, the cost of the guarantee, you book it. The cost of the guarantee is guarantee expense account debit to guarantee liability. Now, how do you remove this guarantee? You are going to amortize it. We have done that, no? Financial liability, one guarantee was given, parent given by the subsidiary. It was amortized. There, different rule, huh? Loss allowance versus, that is a different story here. Here, different account. Yes, done. Yes, now this is a negligible, huh? Just to start that there is one concept. We should not be surprised. Oh, we didn't knew only that the derivative financial assets goes like this. But the most important part in derecognition is your financial liability. Now, what is the rules of financial liability derecognition? Okay, understand now. Huh? Very important. They have asked in the past examination question. See, entity shall derecognize the financial liability when you should remove it from your balance sheet. When it is extinguished, it is no more. And when it is extinguished, when it is discharged, that means you pay. Entry is liability account debit to bank or cancelled. That person says, don't pay me. What entry you pass? Liability to P&L. Expires. He didn't ask me only. Yes, cancel on the last day. That time bar is there, no? You pass liability account debit to P&L. However, if this is the case, this is simple, then we should not discuss only at the final level. Problem comes, sometimes the borrower and lender into new contract, which substantially modifies the terms and conditions of the existing contract. I will ask moratorium period, I will say reduce the interest, I will pay you more time, EMI is cut. Then how should I account it? Such type of contracts. So the accounting depends upon the substantial modification test. We have to apply one test. What is the substantial modification test? It says something like this. You have to find out net present value of the cash flow. That means present value of the cash flows, or present value, not NPV, under the new terms by discounting at the original EIR. Don't take the new EIR. Plus whatever fees you have paid. Because of this moratorium adjustment and all, will you pay the fees? This is when time 0. And you agreed to pay the cash in the more cash in the future, reduce interest in the future, all those stuff, no? That future you find out the present value, but use the original EIR. This is this amount. You deduct the present value of the remaining cash flow under the original. This is nothing but the amortization schedule. You go check the book value. A book value of the amortization schedule is nothing but the present value of the future cash flows, no? In original. And if the difference, check the difference, check the percentage over original cash flows, and if it is more than 10%, you should consider it to be substantial. This is called a substantial modification test. Whenever the modification happens, step 1, apply modification test, because without that you will not come to know. And if the modification is more than 10%, that means it is actually a new liability. Then it's called extinguishment accounting. You close the old liability, recognize the new liability. But if it fails, if it is less than 10%, then you have to apply modification accounting. In the modification accounting, you just continue with the existing loan only. So what accounting entry you will pass under extinguishment? You derecognize the existing liability, that means old liability account debit to new liability, but at a fair value. Old liability will go at a book value. Recognize the gain or loss in the P&L account, which is equal to difference between the book value and the fair value. The difference between these two is P&L account. And recognize the loan modification fees in the P&L unless it is specific to the new loan. See, generally when you modify, the processing fees is meant for old loan or new loan? Old, no? To close that, right? New loan is yet to come. So if they tell you very specifically in the question that this processing fees is meant for the new loan, then what should you do for the processing fees? Amortize. With the financial liability, when you incur transaction cost, what do? Amortize, no? But if they don't tell anything in the question is very silent, your fundamental or basic assumption that the transaction fees is meant for the old loan, transfer to the P&L account. Why? What is the logic? Or a loan itself is not there. What I will amortize there? So the question comes, the transaction fees what you pay, no, on discussion, amortization, did you pay for the old or did you pay for the new? If you have paid for the old, transfer to the P&L account, because there is no point of amortization. Loan itself doesn't exist. But if you are going to pay to the new, you amortize it, but such questions are not there. So question is generally silent. You will always assume it is for the old. That's why that fees you will charge, add it here to compare. And this test is the notional test, because I am using original EIR, not a fair value. I will explain that. Now, if you follow a modification accounting, clear now, Vidya? Then the original liability is going to continue in the books. I don't debit old liability account. Fees paid will be adjusted for the existing liability, because you are since existing liability is going to continue. Whatever fees paid, you are going to amortize. The new amortization schedule is going to happen now. New EIR going to come into picture. We have discussed it already. The transaction fees means new EIR, and no gain or loss. Okay, I will just discuss here, because later we will straight away solve the problem. Sometime what happen now, I will do a modification in such a way that I will not pay any cash, debt equity. I will convert your equity debt into equity. In mergers and acquisition of AFM, we come across this problem. It's called a restructuring. We restructure our equity debt into equity. In such case, you have to de-recognize the debt, debit old liability, recognize equity to equity share capital based on the fair value of the equity, which is nothing but the fair value of the net assets. On the balance portion, apply the modification test and recognize the gain or loss in the P&L. Then balance you check what to do. If you 100% you convert into equity, simple. Old liability account debit to equity share capital. But if you do 60% equity, 40% debt, and 40% moratorium happens, changes happen, then apply the substantial modification test only for 40%. Very interesting and nice problems. Okay, so understand it. Derecognition concept. Yes, so again, I did explain this theory. I am keeping it so that when you revise it, this theory comes handy to you. So modification test. Okay, I will explain now the modification test better so that you appreciate it with the example. Substantial modification test. The equation goes like this. Present value of cash flow under new term, cash flow plus a fee paid if not specific to the new loan at original EIR, because you have to compare apple to apple, versus present value of the existing cash flows under old terms at original EIR should be greater than 10%. This is called a substantial modification. Okay. You have to answer me to understand and appreciate what this substantial modification, what is this substantial means. Now you want to go to Bangalore and stay in one hotel. The hotel name is Zuari Wildfield, very beautiful hotel. So you log into the system. You see that the hotel itself is quoting 10,500. And how much they are quoting in their website? 10,500. That means they don't sell at a discount. But if you look into booking.com, the same room is given by booking.com at 7,200. And the same room is Snap Travel is giving you at 5,656. Followed, no? Now this becomes a commodity to you. This becomes a commodity, no? A same product is offered by three. It's not distinct now. Otherwise, you would have thought, why should I will pay 10,500 only. You say there is no point in paying 10,500 for the same commodity. Now, this is called original price. Correct, no? And this is all discounted price. Now, how, if I want to know what is the percentage of discount offered, what is my equation? Then you say, sir, original price, discounted price minus original price divided by original price. Then you get percentage of the discount. Correct? Or you can say discounted price minus whatever. The denominator is original. And you say that, look, my company is not offering me any discount. This is offering me 31% discount and this is offering 46%. Now tell me, who is offering substantial discount? See, this is what I tell you, students. You have to be very careful in the examination. What is my question? Have you understood my question? You are jumping into the solution. You are not understanding. You are not trying to understand the question. You are not giving any time to understand the question only. What is my question? Who is giving substantial question? Why you are making assumptions? Did I ask you the question, who is giving highest discount? I ask you, who is giving substantial discount? Who is giving? You should, do you know? Then you should ask me. See, that is the quality of a CA. When you are not clear, ask the question. No, you should ask me only one thing. What is that? Sir, what is the definition of substantial? What is your criteria for substantial? Then only I can tell you. No. If you say highest, there is no definition required. But when I ask substantial, I say, look, the one who gives more than 40%. And then you say it is snap trap. The one who gives more than 30%. Then you say that there are two parties who are giving substantial discounts. Followed, no? So, if I compare the present value of the modified, because see, previously you are paying 100 rupees EMI. You renegotiate and pay 80 rupees EMI. Previously you are paying 100 rupees for 5 years. Now this time 80 rupees you pay for 7 years. See, first of all, the lender will not leave 1 rupee also, keep in mind. He will extend it, but he will recover it. Now, this is my discounted price. This is my original price. Discounted price minus original price divided by original price gives me the discount percentage. How much discount he has offered. If that modification is more than 10%, 10% is one benchmark, a criteria. And see, understand, my Ind AS is a principle based. It's not rule based. But hardly few places rules come. This 10% is a rule. Accounting standard is a rule based. It's not much principle based. That's why substantial 12 months period, if you are holding inventory for more than 12 months, then capitalize the borrowing cost. Ind AS goes, if you are holding inventory for a substantial period, capitalize the borrowing cost. It goes with the principle, not with the rule. If you define 12 months, it is a rule. If you define 25% for significant influence, it is a rule. 20% significant influence, it is a rule. Our Ind AS goes with the principle, but hardly few places rules. Are you clear now why 10%? This is my criteria. Okay, so if you are doing substantial extinguishment and modification, this is my conditions of derecognize and all. We will pass this, we will write it again. Modification, if it fails, it is going to do differently. Okay, we will take one example which has appeared in your MTP also. This can be a 14-mark question for you, ever in exam. On 1st of January 2010, XYZ Limited issues 10-year bond for 10 lakh rupees. And students, understand, sir, hardly 2-3 questions we are going to solve. But understand that question in depth because it's a lengthy question. Once you understand, grasp what we are doing, you are done. On 1st of January, they issued 10-year bond. So for XYZ, it is financial asset or liability? Huh? See, that is the starting point. Because if you are not able to figure out, then it is very difficult for you to understand the entire question. XYZ issues 10-year bond, or XY invested in 10-year bond. Issues, then for XYZ what it is? Financial liability. They have issued the bond, no. When I issued the bond, somebody will subscribe. They will pay cash to me. What entry will pass? Cash account debit to liability, debenture, you call it anything. Now, it is bearing 10% interest. When I am supposed to pay? 31st December every year. Okay. The bonds are redeemable on 31st December 2019. Life they have given, be careful, how many years? And below they will give one discount factor also. 10 years. See, our ICI, different ways they will try to give you, different problems, different life factors. Be careful. So this is for 10 years now. No cost or fees is incurred on day one, like good amortization cost, no headache. The effective rate is therefore 10%. Oh, that means this must be at market terms. That's what is my fair value? Transaction price. 10 lakh itself is my fair value. So on day one, what entry I would have passed? Bank account debit to bond account. 10 lakhs, finish. If transaction cost was there, I would have adjusted, then amortization schedule I would have changed. Now on 1st of January 2015, after 5 years, that means 10, 11, 12, 13, 14, 31st December 2014 I finished. Then on next day, first day, and the XYZ and bond holders agree for a modification. That means first 5-year interest I paid. And it is a conventional, when the repayment is going to happen, principal, redeemable. Okay, they have told you. It is a conventional bond. After first 5-year interest, you told, look sir, we cannot give you interest anymore. And we cannot pay you the principal also at the end of 5th year now. 5 more years is left. Can you extend it up to 2021? So I am supposed to pay when 2019, 2021, 2019, 2021, 2 more years. That means how many more years left now? 7 years. The interest payment is reduced to 5%. I cannot pay you 10% anymore. You will make it 5%. But what I will do, this compensation, previously I was supposed to pay you 10 lakh back, no? This time I will pay you 15 lakh rupees. The legal fees of 1 lakh incurred for what? What this legal fees is incurred? For old or for the modification? For old, because literally I want to modify it. So generally we assign it to the old agreement. Followed, no? Now XYZ determines that the market interest rate on 1st of January is 11%. That means today my original is 10%, but the market rate of interest today is 11%. Analyze whether the extinguishment accounting is going to apply or not as per the Ind AS. How to analyze it? For this we have to perform substantial modification test. By looking at the question, no, I don't think so. We are capable enough right now to decide whether substantial modification has happened or not. For this we have to consider what? What is my equation? Present value of the future cash flows at original EAI minus present value of existing. Look into the amortization schedule. That divided by the original gives you the percentage. Check whether more than 10%. If yes, obviously it must be yes here in this question. Determine the fair value of the modified liability. This is first question. Simple. Present value of the future cash flows at a new percentage. That 10% you took, original ERAR, is a notional, only for comparison sake. So you have to calculate a new and compute the gain or loss on the modification. So to pass an accounting entry. Clear? Okay. So first we will do solution. Since there are modifications on 1st of January, did they ask you journal entry right from the beginning? What did they ask you? Analyze the extinguishment accounting is applicable or not. We will speak only that. Why I should speak about original data and all? Originally it was at a fair value, first 5-year amortization schedule, not required, no. So I am going to say, how I am going to check whether substantial? So we have to perform substantial modification test. For this I need 2 information. Out of 2 information, is there any information available with me? Is there any information available with me? I need 2 information to perform substantial modification test. Is there any information available with me? I know what is my present value of the future cash flows at old terms. That is always 10 lakhs only, no? Because original loan was at a fair value. There was no amortization. Understand? Otherwise, you should have prepared one amortization schedule and checked at the end of 5th year what is your cash flow. Otherwise, you calculate separately. In the prepayment option, we have done that. We calculated the future values, present value. Okay. So step 1, right, working note number 1, to perform substantial test, working note number 1, PVCF under new term at 10%, which is original EIA. Present value of the cash flows under new terms at original CA. So tell me, students, I have got a year here. How much? 7th year or 1 to 7 year? 7th year, because I am at the end of 5th year. 5 years more was there. I got extended by 2 more years. So what is my cash flow for 1 to 7 years? 5% on what? 15 is a redemption value. On the face value only I will pay, no. I will pay 5% on what? Face value or redemption value? Face value. What is my face value? Did the face value change? No. That means 50,000. Followed? And on redemption, on 7th year, what is the amount I am going to pay? 15 lakh. Present value factor at the 10%. What is my present value annuity factor? 4.868418. If they give you in the exam, you can take. If the question is silent, you can take anything. That is maintain the same thing here. And my present value factor is 0.513158. So total this comes to 10,13,158. Therefore, total PVCF is equal to 10,13,158 plus, did you not pay processing fees right now? 11,13,000, because when you compare, you have to compare the total cash flows, and that is also a cash flow. This is not from an accounting point of view, because it is meaningless to compare this with the 10%. No, right now rate is to 11%, but only for a comparison sake, apple to apple comparison. Otherwise, I cannot compare. No. So I get 11,13,158. Now, what is my present value of the future cash flows at a 10% under old term? What is my present value of the future cash flows under old terms at 10%? What is my old cash flows? 10 lakhs only. Okay. What we will do, we will simply prove it. Working note number 2. We know that. Actually, we need not calculate. We know it because it is a bullet payment. Present value of CF under old terms at a 10%. So, year 1 to 5. What is my cash flow? 1 to 5? 1 lakh, because you are paying interest of 10%. And the 5th year, 10 lakhs. Present value factor for at a 10%, 5th year, no? Are you not repaying at with the face value only? Read the first part of the question. 5 years already over, no? Now we are in the end of 5th year. From 5th year, 5 more year was there as per the original, where every year I used to pay 1 lakh, 5th year I used to pay 10 lakhs. But what I did, I modified it and I say I will not pay 1 lakh every year, I will pay 50. Remaining 5 years. Because I have to compare, no. What I was supposed to pay versus what I am paying, is it more than 10%? That's what we are trying to test here. Understood, no? Logic. What discount the hotel is offering versus what I am actually paying. What was that original price versus what is the discounted price? That's my saving. So this comes to 3.79 and 0.621. This comes to 10 lakhs only. Actually, we need not do the working. If there was a transaction cost at the beginning, then you needed to prepare one amortization schedule. and maybe not required at that time also, because this value would have been different from the amortization schedule balance. I hope if you got that point, it's perfect. Are you clear? Yes. So first thing, we needed two components to calculate the modification test, right? Substantial modification test. So what is my percentage of modification? 11,13,158. It is my discounted price or new price, minus 10 lakh is my old price, divided by 10 lakh gives me 11.32%. Oh, so the modification happened for more than 10%. That's very substantial. It's substantial. Now we will write one note, because they asked me analyze. No, simply I cannot do this working. I have to tell exactly. Otherwise my communication is incomplete. Since modification is more than 10%, we need to apply extinguishment accounting. Since modification is more than 10%, we need to follow extinguishment accounting. That means extinguish the old loan. Old loan is no more makes sense to you, because it has lost its original identity. Now whatever comes is the new loan. It's like a, see, sometimes this one, I have got one house. There are some, okay, I will change the roof. Previously it was tiles roof, I will make it an RCC roof. Now did I modify the house or did I have got a new house? Now say for this, I will apply the substantial test. You need a benchmark. You simply cannot tell. Sometime what I will do, no, for the namesake I will keep the house. Why? Because I have to apply for the new permit, leave the space for the road, all those headache is there. So front place I will keep, back I will demolish everything, and from the back I will construct one new RCC house only. Front room is same, old room. Back one new RCC house has come. Now it is the new house or the old modification to the old house? It's a new house. So what is the true nature? Then if it is a totally new, then you de-recognize the old, because old doesn't exist. But only some roof has changed, or you have put some tiles you have changed. That's a modification. That means your original house is still there. New house doesn't come into picture. You understood the idea behind this, no? Why we are doing it? So that we communicate to the outside world what exactly is lying there with me. Thus, new, since we follow extinguishment accounting, new loan is recognized now, which was not there, at its fair value, at 11%. What we did 10%, it is only for a test, so that we can compare apple to apple. But since new loan is going to come, we will treat it as if it is a new loan. Today's day, one new loan I am going to get. What I will do with the legal fees is charged to P&L. Yeah, why? Assuming it is for the old. Old doesn't exist anymore. Difference between book value of old and fair value of new is equal to P&L. Finish. This is the way I account it. This is what we were discussing. So I explain how do we do it. Now, can I pass any accounting entry? No. Why? Because I don't know the fair value of the new loan. So I need to prepare one working note. Are you clear? So after you do substantial modification test, you give this note explaining, okay, what is your observation about that test? Simply you do half and half test and all, you don't score full marks there. Because I told you, no, FR, one unique challenge for you is theory has to be written, explaining what it is. Now do working note number 3. Fair value of new loan at 11%. So here you have got 1 to 7 and 7th year. Cash flow you know already, 50,000, 15 lakh. Already we've done, no? Only thing what is going to change now? Present value factor will be at 11% now, because we are trying to find out the fair value, which is 4.712195, 0.481658. This gives you 9,58,097. Very clear how the flow happens? So first we did that, that's what they asked me. If more than what they asked, I am not going to do. Then they asked me, tell me the fair value. This is the second question actually I am addressing. First they asked me, what is the substantial modification? Are you going to apply? I say, I am going to apply. What is the modification? Yes. Now they asked me, what is the journal entry? For journal entry, so I calculated this fair value. Now I need to calculate gain or loss on modification. Generally, will I have got a gain or loss? Loss. See, who went to the lender, sir, please modify? I went to him. No, why he will say? He will not. See, his hand is on my neck now. His hand is on my neck. When you go to the bank and say, sir, please modify, bank will say, I will modify, but you have to pay me the processing fees. You have to pay me whatever you are supposed to pay me earlier, that you have to end to pay me only. Followed? No, so he will not going to leave unless I am really a bankrupt type of person. No, then it is actually a loss. It is a gain to me. But the question is, tells you anything like you are totally a bankrupt type of thing? No, no. Okay. Generally, that's what I am telling. Ooh. No, I went not, see, first of all, in my contract, there is no prepayment option. And why I went? Because I am financially struggling now. That's what I told you. In AFM, restructuring chapter comes into picture. You went there because to restructure it, telling, sir, please extend my term, reduce my interest. But he will do it. He will not do it free of cost. No. He is a banker, Baba. 1 rupee, he will not leave. He is a typical finance person there. Now, to find out the gain or loss, you book value. What is your book value? Actually, it comes from a journal entry here. What is the book value of loan? 10 lakhs. Less. What is fair value of new loan? Because this is the book value goes out. This is like a journal entry now. This is like a debit. This is like a credit. How much? 9,58,097. Oh, that means, see, what goes out is a liability worth 10 lakhs. What comes to you is a liability worth 9,58,000. Gain or loss? Gain. But that person will not permit it to make that gain. No, that's why he will charge less modification fees. This also you should charge to P&L account. So this modification fees turns that gain into a loss of 58,097. If you want, you can pass two separate entries. Your accounting entry will be old loan account debit, to new loan, to gain. Then modification fees account debit to bank. Then P&L. P&L comes into picture. Net effect is loss to you. Are you clear? So this is the gain or loss. Then pass the journal entry, last journal entry. Journal entry will be on the day of modification, 10% bond account debit, loss on modification account debit, because this is netted off. Gain and the processing fees, 1 lakh rupees is netted off here, which otherwise you could have passed separately, I told you. To 5% bond liability to bank fees. Easy, no? But a lengthy question, we are not saying, this is a small example, okay? They may ask you any questions. See, in this question, if you see what you did with the transaction cost, you transferred the transaction cost to P&L account. Why? Because you assume that 1 lakh rupees paid was for the old bond. Yeah, in working note, what we did, that is notional, I told you. If you see in that working note, you found out the present value of the new terms at 10%. Does the 10% make sense? Today your liability is 11%. Why did you calculate 10%? That is just to compare cash flows under new versus cash flow under old. For that sake you compare. It's not for an accounting purpose. The first working note what you did, no, it's not meant for accounting. Accounting, it makes no sense at all, that numbers. That numbers are calculated only for a test, modification test. Are you clear now? That's what, that accounting of the transaction cost comes here. So if I go back to the previous question, your doubt is here. What is this processing fees? This is a notional, Baba. This 11 lakh 13, there is nothing. Do you pass any accounting entry for this? Nothing. This 11 lakh 13,000 you calculate only to compare the cash flows of the old versus cash flow of the new. But when you talk about new, you just add it to the processing fees. Alternatively, do one thing, no. Go and minus here 1 lakh. If you want, show 9 lakh, one and the same. No, but don't do it. Because what standard wants, they say that, I showed you one picture there. They say that the definition of what is my present cash flow? It is the present value of the new terms with the old EIR plus transaction fees. But it is not meant for accounting. See, up to here, these numbers are not meant for accounting. This is meant only for to test. Then comes the numbers. This number is meant for accounting. That 1 lakh is meant for accounting. Followed, no? Yes. So we will move on to the next question. One more example. 2 examples they are given. On 1st of January, XYZ issues 10-year bond for 10 lakhs. Same story. Interest is 10%. Bond is redeemable 2009, 10 years at 10 lakh. No fees is incurred, effective. Same, correct? Now on 1st of January 2005, after 5 years, is it correct? 1, 2, 3, 4, 5. No. How many years? After how many years? 2010, 11, 12, 13, 14. Yeah, 5 years. The bondholders agreed for a modification. No more interest is paid. Chalo, last time at least we paid 5%. And the bondholders will be redeemed with the 16 lakh. Last time it was 15 lakhs. Legal fees is 50,000. Last time it was 1 lakh. And if effective rate is 10.99%. Now bonds will be redeemed when? On the original due date only. That means 5 years, not 7 years, but with 16 lakhs. But next 5 years I will not pay any interest at all. Understood, no? Now account the same. And they said new effective rate. Why? I don't know why they gave me at this point of time. Let us see whether it makes sense as we go proceed further. This makes sense to me if we apply modification testing, not extinguishment account. In modification, what happened? No, my existing loan will continue because if the modification is less than 10%. In that case, this transaction fees I need to adjust with my book balance. Then my new EIR is required. Probably that 1.99% is that. Understood, no? So for this we will test whether modification or not. Yes, right. Since there are modifications, we have to perform substantial modification test. Same story we will write. Yes, working note number 1. To perform modification test, working note 1, PVCF of new term at what percentage? 10%. And in fact, if you see, they have not told you new interest rate also on the date of modification. Not that. On that day, what is the market rate? Previous question, previous 11%. Don't think that 10.99 is market. They said effective. Understand the difference. Previous question it was 11. See, this is the way they try to fool you. You start thinking, oh, this 11 and that 10 point same. There I didn't need effective because market itself is effective for me. In this case, since I don't apply extinguishment, then I need an effective. Okay, so how many cash flows are there now? Only one cash flow. So present, you can write PVCF is equal to, what is that cash flow? 16 lakhs into, what is the rate of interest? 10%. For which year? Fifth year from now, 0.621 is equal to 9,93,600. Do you have any processing fees? Yes, add processing fee 50,000. So 10,43,600 is the total PVCF. Followed, no? And again, this number has got no accounting entry. This is a meaningless number actually for accounting, but very meaningful account purpose number for comparison. Substantial test. Otherwise, neither I pay this, nor I prepare any amortization schedule. So this number is not used anywhere other than substantial test. Now, what is my second working? PVCF of old at 11%. Again, in the examination short of time, you can give a note. It is 11 lakh only, but we can also prove it. So PVCF is equal to how much? What all the cash flows you have got under old terms? Oh, sorry, I'm sorry, 10%. 11, I just went with the last. 10, old, same, no? So what is, how many cash flows are there? 2. What are those? Principal 10 lakhs I need to pay. How many? Into 0.621 plus how much is the interest? 1 lakh. Same, no? Previous question, no? Into 3.79, which gives you 10 lakhs only. We know it. Before doing it only, you know that it is 10 lakhs. Pretty clear, no? Before doing it only, we know, but just we demonstrate it. This is my old cash flows at the old terms. Alternatively, I could have found this book value in amortization schedule. Done? So next, I'll perform a substantial modification test. So percentage of modification is equal to 10,43,600 minus 10 lakhs divided by 10 lakhs. Gives me 4.30. Oh, that means this modification is not that substantial. Only maybe I have put tiles there, or toilet and bathroom I only have changed. That's a small minor modification. Will you have one housewarming ceremony for that? No. But fully you demolish and construct totally new, you will have one housewarming ceremony. That means old de-recognized, new you recognize officially. Correct? But only thing is, in there we don't have any test as such. It goes with the gut feeling. Here we have got a objective test based on the experience. Now, what note I need to write? Since modification is less than 10%, we need to apply modification accounting. So what do we do here? Can you tell me? We will no new liability is recognized, but will continue with old one. Since we continue with the old one, no gain or loss. So that gain or loss entries, calculations, we are not going to do it. Then only one question comes, sir, then what about this fees paid? The fee paid, previously I charged to the P&L account, is adjusted to book value of loan and subsequently amortized with new EIR. Perfect, no students? Dot clarity. Is the new EIR you are going to analyze. So this is the story. When you practice, you can consider this. Yes, students. You're clear, no? So we are going to perform no modification not substantial, no new liability, no gain or loss, fees paid will be adjusted. So what is your modified value of the loan? Modified value is equal to book value 10 lakhs minus fee 50,000. 9 lakh 50. So going forward, you are going to amortize 9 lakh 50. This is your modified value of the loan. So what is my journal entry? What is my journal entry? Huh? Why should I debit? It is still there, no? Yeah, correct. What you said is correct. 50,000. So my accounting entry is liability account debit to bank, not full. If I am going to for extinguishment, I will close this full, recognize new at a fair value. Since I go for a modification, I just modify it, and going forward, I am going to prepare my amortization schedule. Now 50,000 is reduced from the book value. I use that new EIR of 10.99% and prepare that amortization schedule. That they didn't ask us. We just asked how do you account. We said explain. Clear, no? So they may ask you any of this question. Now we come to the important question. Not this question, the next question is very important. But what I have done in the study material is a very big question with the big numbers, so that it is very difficult for you to understand. I have created a miniature version of it, a small version. So we'll solve the small portion. Big problem, I want you to solve it yourself. Now, Tire and Co borrowed 50,000 rupees from a bank on 1st of January 2011. The original term is how much? 11% interest you need to pay. Repayment of the principal in 5 equal installment, non-conventional bond. Step 1, contractual cash flow. The moment you figure out non-conventional bond, step 1, contractual cash flow. Because if it was conventional, then it is very easy, 1 to 5 years, 5 years, that you could have done. So the payment of interest is annually on accrual basis. Chalo. Is this loan at market terms or off market terms? Forget about other things is not related to this. Up to here on day 1, it is at market terms. So what is your transaction price? Is a fair value. This must be the fair. So you will prepare an amortization schedule, contractual cash flow, but we know that it is the same. That means there is no difference. Okay. So fair value will be 50,000. On 31st December 2012, when you took on 1st of 11, 31st December 2011, first year finished, you must have paid the interest and 1 installment you must have paid. Second year, you approached the bank citing liquidity issues, meeting the cash flows required to pay immediate installment. They said, sir, I cannot pay the EMI. Now this one I added, study material didn't add this word. Study material is silent about it. But in the solution, they have given this. After due negotiation, they agreed to pay the contractual interest due. But in the exam, they asked, see, told. Because if I do this study material question, no, instantly you'll ask, sir, where they told this? Question is silent. But in the solution, what they have done, no, when the EMI was due, they paid the interest only, not the principal. But when they asked in the exam, no, they told like this, what I have written, no, here, this is the examination sentence, I'll show you. That they paid the interest and the balance amount, that how much installment, students, can you tell me? 50,000 I need to pay in 5 installment, no? How much is 1 installment? 10,000 rupees. First year, on 50,000 rupees into 11% plus 10,000 I paid. What is my outstanding book value of the loan? 40. On second year, 40,000 into 11% I paid, but 10,000 I didn't pay. Understood this, no, concept? Yes. Then I applied for renegotiation of this 40,000. Then the bank said, okay, I will give you 15% interest. You have to pay me 15% interest. Repayment of the outstanding balance in 10. Then what you do? You pay me 4,000 going forward in 10 equal installments. That means what I was supposed to pay next 4 years, it's going to get extended to next 10 years. Because of the low EMI in principal, they increased my interest portion from 11 to 15. Payment of interest should be on annual basis and repayment of the principal will be same 50 over. No, equal installment. Now I am paying in equal installments. Now record the journal entries in the books of Tire and Co till 31st December 2013 only. That means I renegotiated this the very next year. That's it. Next 10 years you need not pass the entries because it's the same. No, you have to prepare one amortization schedule and then pass. But after giving to the effect of the changes of 31st December changes. Right? Solution. The given loan is at market terms. Hence, fair value is equal to transaction price is equal to 50,000. So we will calculate the cash flow also. We will prepare amortization schedule also. Because it is same here in this case. Both are same. So write working note number 1. Calculation of CCF bar amortization schedule. I will write here date. Date will be starting from 31st December 2011. 31st December 12, 13, 14, 15. This is as per my original contract. What was my opening balance? Yeah. Was there any transaction cost? No. So what is my interest will be? 11%. 5,500. How much is the principal? 10,000. So how much is the total cash flows you end up paying? 15,500. Balance will be 40,000. You see how beautiful it is. When you enter into take a loan at market terms, accounting entry is bank account debit to loan. The contractual cash flow schedule itself is your amortization schedule. What interest you pay is what interest you recognize as an expense or income. But if you enter into off market, then literally you end up confusing people there. So that they come to the chartered accountant and say, please explain this. We will explain. So next it becomes 40. Interest is 4,400. 10,000. So are you clear? No? 30. So we need not do this and write the balance blank. I think we can proceed further. You can fill it later. Followed, no? They asked me journal entry on 31st December or up to 31st December? Up to, no. The purpose of preparing this is to pass that journal entries now. Why on earth otherwise I require this amortization schedule. So I will go and pass the journal entries. Next step. Yes, students, you can pause the video and complete this amortization schedule. On 1st of January 2011, what is my journal entry? Bank account debit, no? You have taken a loan, right? In whose company? Tire and Co we are accounting. To loan. Initial, first 50,000. Because my fair value of the loan is transaction price. Then comes 31st December 11. What entry I'll pass? Loan account debit, finance cost, P&L, debit, how much? 5,500, 10,000 to bank. 15,500. Anybody in the world is going to understand this particular transaction. Clean transaction. Life is very simple. Accountant is able to go home early, spend time with the family members. AGM, no discussion. They present the financial statement. By looking at it, they understand it. No explanation is required. Auditors also, life is simple. Now comes one catch. Modification. Unnecessary. So I have to apply the test and all. Okay. Are you clear about this journal entry? Then comes 31st December next year. What happens now? What entry I'll pass? 31st December, only interest. So I'll pass the entry, interest expense to bank. Whatever interest accrues, okay, you can call it finance cost, interest expense. Only finance cost accrues. That to bank I will do. Now I need to pass subsequent entries. I need to pass subsequent entry. But can I pass the subsequent entries? Depends on what? So it depends on substantial test. Because unless I do substantial test, I don't know whether that the new entry adjustment should be recognized as a new loan or adjustment to the existing. So right, since there is modification, we need to perform substantial modification test. Since there is a modification in the terms, we need to perform substantial modification test. So what do I need now? What do I need? We have the future cash flows under new terms at the original EIR. So I will write one heading, working note number 2, PVCF of new term at 11%, old EIR. Now can I say 1 to 7 year, 1 to 5 year? No, because these are unconventional. So I will write here date. I'll write the heading called the date, opening balance, interest I need to pay at what rate? 15%. Principal payment will happen, total cash flow, present value factor will be at 11%. So this is the difference between, because previous was the conventional bond, life was simple. This is an unconventional bond. So the only way to cash flow is this table calculation. So when is my date? 31st December 13, next year. No? Right now I am going to find my value. We are on 31st December 2012. So what entry should I pass right now? Because when the modification happened? They came on 1st January, on 31st December only. They came on 31st December only, on the day when they were supposed to pay the EMI. And then only one contract got signed. What was the balance of the loan? 40. Amortization schedule is 30, but did you pay that 10,000? No, 40. You add back that 10. Now interest is how much? 6,000 for next 1 year. Yes, Vidya, are you clear? Perfect, no? Everyone. Very important. That's why I am doing slowly, taking you through this question one by one. Otherwise, it's a confusing thing. How much is the principal payment? 4,000. Cash flow? 10,000. Now, this cash flows, present value factor will be 0.901 at 11%. 9,009. Then comes 14. What is your opening balance? 36,000, because you paid 4,000 already. On this 36,000, 5,400 is going to come. Then you know one thing, oh, that means I can actually fill this 4,000. After some time you will figure out one pattern there. Till that time be careful. Now the total amount comes to 9,400, and in fact you can fill up this All these values you can pre-fill it. You know that. It will not change. So if it is 9,600, this also you can pre-fill. Correct, no? Every year principal is going to get reduced by 4,000, no? Date also you can pre-fill. So this will be much faster, no? Once you pre-fill all these values, if you want, otherwise you can do one by one also, then you fill other values and you get the present value of the future cash flows to be 45,980. Yes, students, you can pause the video and you can complete this. Yes, sure. So we'll proceed further. What is my next working note? I will say that calculation of the carrying amount of the old loan. So write assumed, if they don't tell you very clearly in the question, assume interest only paid on 31st of December 12. Here in the question it is told, but in the study material question it is not told. In the examination question it is told that they only paid interest, not the principal. Then this assumption is not required. If the question is silent, make an assumption that interest they paid but principal they didn't pay. So book value of loan is what? Is equal to 40,000. Go and look at that amortization schedule. You already prepared. And we don't need to do a working because already that amortization schedule is available. Only confusion for us is whether have they paid that interest or not. Otherwise my book value of the loan would have increased with that interest expense also. Since I paid, otherwise my accounting entry, no, interest expense to bank, instead of that interest expense to liability. Now I need to prepare a substantial modification test. So what is my percentage of modification? New value is 45,980 minus 40,000 divided by 40,000 gives you 14.95%. Substantial modification is applicable. That means I need to perform extinguishment accounting. Note. You have to write a note. I'll proceed further. Note. Since modification is more than 10%, extinguishment accounting applies. New loan at fair value. I'll give shortcut here. Difference P&L. Because this is a genuine lengthy question, you need not write all the story, otherwise you can just write the theory. So if I have to do extinguishment accounting, I need one information. What is that? Fair value of the new loan. Okay, right? Next, calculation of the fair value of the new loan. Since new loan is at market terms, why? They said you have to pay 15%. What is the market? Have they told you? In the first question, they said 11%. At that time, market rate of interest. Market rate of interest was 11%. This is what they told. Have they told you here in this question? No. Therefore, the face value of loan is its fair value. 40,000 is the book value. No? That itself is its fair value. If you want to prepare amortization schedule, you prepare, no? Present value of the future cash flows at 15%. You get the same thing. Yes, so let us pass the journal entries. What is my journal entry? On 31st December 12, we passed one entry. Second leg we didn't pass because we only paid interest and then we applied for modification. What it turned out? It's an extinguishment. So old loan account debit it goes at 40,000 to new loan account, comes at 40,000. So no gain or loss. If at all they had given me a market rate of interest on this day so and so, then you would have found out the present value of the new terms with the new rate of interest. It would have been less than 40. Difference would have taken to P&L account. Further, is there any modification fees? No. That's why I don't have any gain or loss. If modification fees was given, it would have been added to the gain or loss. On 31st December 13, loan from bank or new loan account debit, because no more old loan now. New loan account debit, how much? 4,000. Finance cost, how much? How much is my finance cost? 6,000. We already calculated it. To bank, 10,000. That's it. Done. This is called a modification accounting for this. Have you understood very clearly? Have you compared it with the previous question? You understood what all catches can happen? Yes. I will put one small garam masala, that chakke or ilaichi, to this question. Same question. Done? Yes. So now we will move to the next question. Very important question. This you have to understand. Previous question is a simple question. Don't expect. This question can come in the exam, because this is the true version of the study material question. A and Co borrowed 50,000 loan from a bank on 1st January. Same story here. Only one small change happened. Rate of interest 11%. Repayment 5 installment. Interest upfront fees is 587. Now you see how it's going to change your accounting. A transaction processing fees you paid on the original loan. So what happens now? What is fair value? What is fair value? 50,000 only. Transaction price itself is the fair value, no? It is at market terms or off market? Market terms. But what is your initial recognition amount? Minus 587. Now, the moment you do minus 587, you need one EIR. Is it 11%? No. They told you 11.5. The difference is because of that interest cost amortization. Chalo. Up to here, this is one thing. Yes, sir, this is simple. We started with this only, in example. But the problem comes now. On 31st December, they approached the bank for liquidity. They said we cannot pay. They paid the interest, but they didn't pay the principal. Interest will be at the rate of 15%. We will pay for next 10 equal installment. Everything is the same question like the previous one, except these two sentences. So if I give one amortization schedule, how it's going to work out? We'll see. Solve. Right. The loan is at market term. Therefore, fair value is equal to transaction price is equal to 50,000. Fair value, there is no change. The transaction cost is adjusted with fair value of loan. New EIR is 11.5%. We just write initially, because we have to pass one accounting entry right now. We understand my opening entry would be bank will be less than 50, because transaction fees I have paid. So what should I do now? I should prepare one amortization schedule versus contractual cash flow schedule. So I start with the date, opening balance, but this is not an amortization schedule. Both are different this time. Followed, no? Why? Because of my transaction cost. Previously, since transaction cost was not there, amortization and contractual cash flow statement was same. So what is my contractual cash flow? This is same like previous. We'll prepare only for 5 years. It was meant for 5 years. 31st December 11. Opening balance is 50, 5,500, 10,000, 15,500. Closing balance is 40. Followed, no? Same story. 40. Okay, so I think you can leave some space because it's the same thing we have done for next 5 years. This is the contractual cash flow. You can just note down the contractual cash flows because ultimately this calculation we are doing for this purpose. You can note down only this because other things fine, administrative. Clear, no? Vishnu Priya? Perfect, no? Clear. Yes, now I will prepare an amortization schedule. Right, working note number 2. Amortization schedule. Yeah, because I need to prepare now. EIR changes. So what is my date? 31st December 11, 12, 13, 14, 15. What is my opening balance? 49,413. Because with the contractual cash flow, I know I can pass one entry, and if I find out the present value of this, can you tell me, students, at 11% if I take, what is that I am going to get? If I take the present value of this cash flow, what I am going to get at 11%? 50,000. It's a fair value. Since I have adjusted the transaction cost, I start with this. What is my interest cost at the EIR? 11.5%. 5682. See, understand, to solve this problem, how much your understanding of the financial liability is required. It's interconnected. I cannot explain this unless we are very strong at that. That's why somebody misses the classes, no? They find it very difficult to grasp at a later stage. What is that you are trying to explain? Baba, these things, those basics only. It's all plug and play. One concept gets added there. Now, what is my CCF? 15,500 in the previous working we have done. What is my closing balance? 39,595. This becomes my opening balance. Interest becomes 4,553. CCF 14,400. Working note number 1. Closing balance 29,747. Followed, no? Yes. So like this, I'll continue. Yeah, generally I have given here, shown separately, but not required. Okay. If you want, you can keep it. Yes, friends. So you can pause the video and complete this. I want this you to complete. Yes, done. So I am ready to pass the journal entry now. I can pass the journal entry. Yes. What is my journal entry? On 1/1/2011. Can you tell me the journal entry? Bank account debit, how much? 49,413. To loan, 49,413. If you want, you can split this. Bank to loan, transaction cost to bank, P&L to transaction cost. So many things you can, loan to transaction cost. You could have done. On 31st December 11, can you tell me the journal entry? On 31st December 2011, 49,413, no? 413. Can you tell me the journal entry on 31st December 2011? I am interested to hear that journal entry from you. Loan account debit, how much? Whatever. Yeah, tell me the entry first. Finance cost account debit to bank. Yes. 5682 where? 5682 15,500 9818. Perfect. This is what we have to do, combined entry, where it was a balancing figure. Previous question we knew it because there is no transaction cost sitting there. Because in this process, one transaction cost is also getting amortized. So this is the entry I am going to pass. Clear? Now, can you tell me what is my journal entry? I'll proceed further. Can you tell me the journal entry 31st December 2012? Finance cost account debit. How much? 4553. To bank. How much? Huh? How much is to bank? Hmm? 4553. Yes, Vishnupriya, what is your opinion? Huh? 4553. What is my bank? See, don't think like a student. Huh? Think you are there sitting as an accountant there. You are the auditor there. What should be? What should be the reality? 4,000? Are you convinced? Perfect? 4,000. Contractual cash flows you look, no. You think why you are going flown by the amortization schedule. Amortization schedule is meant for your accounting entry. Like this, I will also pass one accounting entry. Bank account debit to equity share capital, 100 crore. Do I have that money with me? No, no. Accounting entry doesn't make any difference. But if I really get 100 crore, I need to pass that entry because my entry should represent the truth. Understand? As an accountant, what we are trying to do? We are trying to figure out the truth and bring that truth out. What is the truth? You paid 4,400. What is the interest cost? 4,005. What is the difference? The difference between these two is nothing but the initial interest cost amortization, the transaction fees amortization. Now difference will go where? To loan, no. Balance. Previously you put a balancing figure as a loan there. Why you are not putting balancing figure as a loan? See, that's the catch. This creates all sort of confusion on transaction fees. But if you understand what exactly it is, because see, you booked more value, no, Baba. That you would have credited. If you would have paid, amortization schedule would have become zero there. See, students, please understand. It's a very interesting, very nice, very conceptual. It gives a lot of food for thought for you, how it goes. And you do, you become strong in mental calculations. In your mind only you understand, okay, where it went, what happened. Yes, Vishnupriya, are you getting? Are you very clear here? Why I am crediting it to the loan? Because I account interest cost of more than this, because the difference between these two values, 153, is my interest cost, transaction cost amortization. But I am not paying anyone. I would have paid eventually I would have taken it out. That's why I credit to the loan. So my loan balance actually increases, 153. Are you clear? Now what should I do? What is my next entry? But wait, the problem comes, I went to the bank for negotiation. Right, note, there is modification. We need to apply substantial mod test, sub-mod test. Because there is a modification now. Next accounting entry, whether it is a extinguishment or whether it is a continuation, I don't know. For this, I have to apply the substantial modification test. For this first thing, what I will do? Present value of the CCF under the new term with the old EIR. Present value of the new terms. So 31st December 2013 now. How much is my opening balance of the loan? Yes, Vidya. How much is my opening balance of the loan? Sorry? $40,153. Am I asking you now from whose perspective we are finding out now? What is this? This is a contractual CCF, no. What your CCF has to do with your book value, accounting entry? CCF comes with what you have paid. CCF comes with what you have to pay to them. Okay, how much loan you took on day one? 50. Out of this, what you paid till now? You paid to interest. One principal back. What is the book value of the loan? 40%, 40,000. No. Contractually, you have to return 40,000 back to them. And they said, look, on this 40,000, you have to pay me 15% interest. And you return me for this 40,000 in 10 equal installments. Same. Did you not this in the previous question? Why you got confused this time? Why? Because of that one garam masala called transaction cost. And institute, I will take you to the next level. You know the amount of the loan what you have taken? 50 crores. After 5, 7 zeros are there. And then you have to prepare a schedule like this. 40 crores, 36 crores. With the transaction cost of 53 lakhs. Okay, now what is my total CCF? 10,000. Yes, Vishnupriya, are you clear what we are doing? No, you can ask me doubts if any of the points you are not clear. So we will fill this first. On 31st 2014, the opening balance of the loan become 36,000. Then I told you, oh, there is a pattern. 32, 28, 24, 20, 16, same no. 8, 4 and dash. Interest will be 5,400, 4,800, like this go on. Principal repayment will be same 4,000 fixed. Cash flows also you can find one pattern 9,400. You multiply with the 11.5% because this was the EIR rate, not the loan rate. And you find out the present value of the new terms of the cash flow. That's why you took 40,000 because you wanted this cash flow. This is what you actually pay to that bank, which differs from what you have accounted. That comes next now. What is the book value? Then you should tell me, sir, it is 40 plus 153. First loan is an off-market term. Then your off-market term, fair value will be with the thing, but the moment you adjust transaction cost for that off-market rate, your transaction fees rate will be added. So ultimately, EIR is the amortization schedule. What rate comes? No, same thing you have to take. Understood? Please ask me doubts. I like you to think. I'm ready to spend time here because I know what it is. And ICA also knows. That's why they give you this type of questions in the exam. And you can expect without any twist. Plain question only. But you will spend considerable time unless you practice it very fast. See, otherwise you can take a choice here. But a compulsory question, not a big deal. No? It's actually easy question. Yes, students. So you can pause the video and complete this table. Yes, students. So I'll proceed further. So what should I do next? Perform. I want the book value of the new loan now, existing loan. Calculation of the working note number 4. And if you say I have maintained the same format, book value of existing loan or PVCF under, not book value, we can write PVCF of old terms at 11.5. Can you tell me, students, what is my present value, not book value? Please understand. What is my PVCF of the old term at 11.5%? Sorry? 41, 38. Okay, others, I want you to please try and tell me. Okay, others, I want to know from others. Yes, students, I'll just pause the video because I want to give time and I want you to work it out, the present value of the cash flow under old terms, and be ready for discussion. Okay, students, I hope you are also come up with the number. So write closing balance as on 31/12/02 or 12 as per amortization schedule. How much? 29,749. But that is as per a schedule. But as per books, what you should add outstanding principal, because that schedule 29 would have been your real book value provided you added paid. No, 39,749. So this becomes your present value of the future cash flows. Alternatively, if you really want to work out, can you tell me how many cash flows are? See, you are into 1, 2, 3, 4, 5. What is my third year cash flow? Third year cash flow as per the old term. So can you tell me the cash flow, students, for the third year? First year you have paid. We want at the end of second year now. It is 13,300, 12,200, 11,100. Did you pay 10 times 0? If you find out this present value, 1 divided by 1.11 to the power 3, 1 divided by 1.11 to the power 2, 1 divided by 1.11 to the power 1, plus 10,000, you will get same, no? At 11.5%. 11.5, yeah. So I told you, when you look at an amortization schedule, always, the present value of the future cash flow is nothing but its book value. In this case, it didn't work. The only reason, because you didn't pay one of the principal there. If you would have paid this 10,000 also, and they said, then please reschedule my payment, then 30,000 as the balance amount, which should have been spread over next 10 years, and the present value of the future cash flow is this balance, which is nothing but your amortization schedule balance. This is concept. Followed, no? See, one is procedurally, you know that. You copy it, you do it. Anyhow, the probably this question may come as it is in the exam also. So procedurally you do, you excel it, ace it. But what exactly it is? What is this amortization balance? How to get the future value? If they twist, no, then you get into a real challenge. So for this, you should ask a question when solve, no? What is this? Why it is like this? Followed? Okay, so now let us do the substantial test. Substantial modification test. So write percentage of modification. 45,152 minus 39,749 divided by 39,749 gives you 13.60. Oh, this is more than substantial. Again, what happens now? Substantial modification test is extinguishment accounting is applicable. So we'll write note, extinguishment account is applicable here. The new loan will be at its fair value. Difference we will transfer to the P&L account. Now what is the fair value of the new loan? What is the fair value of the new loan? 40 only. 15% have they told you market rate. That means whatever outstanding balance was there, that itself is your fair value. Is there a gain or loss on modification? No transaction cost. But what about the original first transaction cost? That balance will, see, you are doing extinguishment accounting. What goes out? Book value of the loan goes out. Is the book value and your new value is same? No. Previous question it was same, because both were at market terms and there was no transaction cost. But the moment transaction cost comes into picture, we have got a gain or loss. And this gain or loss is the original transaction cost. Next, write fair value of the loan. New loan at market term. Hence, principal amount is equal to fair value is equal to 40,000. What is the fair value? 40,000 is the fair value. You can take a risk also here, not to mention it. But you should know, that's what I'm maintaining a format here, so that you don't miss that. Generally, if they change it, then we have to calculate here at this point of time. That's why, even though not required, I just give a note. So that in, I don't know, suddenly they will say 11%. Then we may have to calculate. So working note number 6, calculation of gain or loss on modification. So what is your fair value of new loan? 40,000 less. What is the book value of old loan? 39,749. We already calculated. So 251 is the loss on modification. Because which liability goes out is 39,749. And 251 is nothing but, can you tell me, students, what is this 251? What is this 251? Can you tell me? Transaction. Have you understood? This 251 is the 573 you incurred. Out of that 2 year you expensed. Till some balance was lying. Now old loan is not there. What should I do? You transfer it to the P&L account cumulative. When this was not there, 40-40, you didn't find any problem there in my previous example. Here you get a 251, which is that unamortized balance of the transaction price. So pass the journal entry. So I'll pass the old loan account debit 39,749. Modification loss is 251, which one time cost for me, which will go into the P&L account, to 50% loan. Now tell me, up to when they asked me to pass the entry? 31st December 2013. So can you tell me what is my next year entry? This is when on the day of modification, I paid one interest portion and then I modified it. After modification, I passed this entry. Why? Because it passed the substantial modification test. If it would have failed, then I would have not passed any entry at all. For that previous balance of 39,749, I would have continued it. Because it is not modified substantial, there is no transaction cost incurred. I would have continued. When? This is that new loan. No? This is that old loan. 15% loan account. I'm sorry. New loan account debit. Okay, 15% loan account debit. How much? And then tell me the entry. Finance cost account debit to bank. How much? Bank is how much? 10,000. Where do you find this? Look at the new loan. Where do you find this? Did you calculate the contractual cash flow of the new terms? There you paid 10,000. Finance cost. Contractually what you are paying? 6,000. Differential. Actually, that since the new loan was at your market price, the first part what you calculated contractual cash flows, no, that itself is amortization schedule, no. Because going forward, the amortization is going to happen at 15%. Why? Because the original loan was at 15%. That's sorry, not original, the new loan. And off market was not an off market. If it was off market, then that new loan will be amortized at a different discount rate. If it was off market, then this would have been different. You would have found out the fair value again. Difference would have gone to P&L, whatever it is. Then this should have been amortized at that whatever discounted rate. And if the transaction cost was there, you would have added that to P&L account as part of the old. You will not adjust to the new fair value. Which one? EIR not required. My discounting factor itself is my EIR. whatever market rate is there, no, which is my discounting factor itself is the EIR. But if the new, if at, they don't tell you, if at all they tell you that the new transaction cost is pertaining to the new loan, then in my substantial test, I will include it. But when it comes here, I will not take to P&L account, but I will adjust to the fair value of the note, and then I need one new EIR. Because 40,000 is discounted at the market rate, say for example. In worst case, they say that the transaction cost is pertaining to the new loan. Then new loan will be accounted like a new liability. You don't take to P&L account. Perfect, no? So this is my 31st, okay, how many entries they said? Okay, this is the entries we passed. These are the two entries we passed.